All right, welcome again, everyone. Adam Richard from 2 Prime is here to give us his presentation on cyber currencies. Adam is the Director of Capital Formation at the firm 2 Prime, and he's sitting down in sunny Miami. So Adam, thanks again for participating tonight, giving us your talk. So over to you.
Thanks, Roy. I know most of you don't have your video on. It would be helpful for me to understand a little bit about, and Roy, maybe you can help answer this too, kind of the degree of expertise or lack of knowledge or any knowledge in this space. I started off my deck, starting kind of at the very basics. And so I'm happy to spend plenty of time on the basics, or we can kind of get more into the real use cases of it all. I just want to make sure I spend the time to capture the whole picture, and we have plenty of time. So
yeah, okay. I can't speak for the group, obviously, Adam, but I think it would be worthwhile to go through the basics.
Okay.
You don't need to dwell on it, but go through the basics. The presentation will be available after Adam talks tonight, so we can get that out to people who are interested in getting his deck, and we'll leave it at that.
All right. So I'll just do a quick introduction about myself. Get this screen shared for you guys. Can everyone see that okay?
Yes.
All right. So I am not a CFO. Thought about going down that path not too long, a while back. But started off my career really as a tech entrepreneur, software developer, did corporate branding for kind of in my earlier years of my career. But the software development and that really evolved into being a tech entrepreneur, had a couple of software companies. And going down that path led me to discover Bitcoin late 2012. And by the summer of 2013, I started the Houston Bitcoin meetup. From 2013 to 2018, grew that to about 3,000 people. So I was really just educating, evangelizing, giving people resources in order to, use this technology. And so my focus was really on teaching people the basics, but then myself creating software solutions and did a lot of consulting for entrepreneurs in this space. And then I spent the last 3.5 years actually at an investment bank, broker dealer, and RIA in order to really come up to speed on traditional finance and kind of how private placements are done, deal structuring, debt, and help structure an RIA that was focused on digital assets. Created a transfer agent. Briefly spent some time building a cryptocurrency exchange. Built out a private securities valuation and rating service that also did ESG ratings. And in doing that, spent time producing valuations on companies in the cryptocurrency and blockchain ecosystem. And recently joined a hedge fund. And it's a hedge fund that trades crypto volatility options. And we work with a number of different fund of funds. We have clients that are family offices, and then also companies that hold crypto on their balance sheet as well. And so I can get into any of those aspects later on, but I want to kind of jump into what it is that I do, or more accurately, what the technology is and what it does, why it's interesting to me, hopefully to you guys as well. And so jump to the next slide here. So you kind of have to start with, in order to understand why a company builds in the cryptocurrency ecosystem, or why a company might hold cryptocurrency on its balance sheet, you really need to understand what motivates them to do that, And that can be a company that actively builds and creates products and maybe even creates a cryptocurrency in the ecosystem, in the blockchain ecosystem. And so the blockchain itself has been around for quite some time. I don't know, going back to, I don't know if it was the early 90s, mid 90s. And it's just a network of computers that agree on a series of transactions that we call the ledger. And so instead of using a double entry accounting system that we all know, it uses a kind of a triple entry accounting system where everyone on a network plays by the same rules, and they all agree that the entries in the ledger are valid and true. And so they agree on this at some time interval and agree that that at every given time interval, there's a state of those books, of that ledger, just like we do in regular accounting. You know, we might close the books at the end of every day or every quarter. There's a time interval at which we agree that this is the final state. And typically on blockchains, that occurs anywhere from every second, every 15 seconds, every 10 minutes. There's different blockchains that have different time periods where we agree upon the state. And so there's no centralized authority that says this is the state. We all equally vote on the state of it. And it just keeps going and going and going forever. And typically when people think about blockchains, they think about Bitcoin, right? The first, most popular, most traction of all blockchains. And this would be a public blockchain. And so your Bitcoin, your Ethereums, your well-known cryptocurrencies that are out there kind of fall into this public blockchain. But then you also have other types. And so you have federated blockchains and you have private blockchains. Federated blockchains are utilized by, for example, banks, right? A consortium of banks can agree to use a particular blockchain, and they can do, let's say, overnight settlement on this blockchain, but amongst themselves. And so it's a closed network for them, and they can invite more people in, or maybe anyone can join in, but they set the rules, right? A private blockchain would be something that's really kind of used internally. So a company can choose to run their accounting ledger on a blockchain instead of in QuickBooks, for example, or in just a regular database, right? And so I'm an advisor to a company that uses a private blockchain to keep account of all the users on their platforms, their account balances. They hold different assets. They move between these assets. And so instead of keeping track of that in a database, they use a blockchain. And there's different pros and cons to each of these that we can get into. But generally, when people are talking about blockchains, you're usually referring to a public blockchain. So the benefits of Bitcoin, for example, this is the most popular blockchain. And usually whenever we're looking at companies that are holding cryptocurrencies today, we're talking about Bitcoin. And so it's modeled after a commodity scarcity like gold. The protocol uses cryptography to create a digital property, and it verifies property ownership through mining. So what I was mentioning earlier about how these computers on this network agree at some time interval of the state of the ledger. Bitcoin achieves this by doing this proof of work process. And so all these computers that are agreeing on this state of what's valid and true, what they're doing, we call mining, because they're incentivized to participate honestly, because if they do, then one lucky winner at every time interval is rewarded with a block of Bitcoin. And all this happens using cryptography. And it creates this cryptography creates a system that makes it so that it's very hard to break the system, but it's very easy to check the math and know that everything is being done according to the rules. And because this network of computers that participate in the creation and the consensus of the state of this ledger all participate in a democratic system where there is a defined set of rules that you have to play by, it means that anybody can come in and participate, right? So there's no trusted third party that anyone relies on in order to say what is or isn't true or what can or can't be done. It's hard coded into the software, and you can choose to participate or not. And because of all of this, it creates a number of properties that are quite unique. So the decentralization that we mentioned, the immutability is the reason why Bitcoin is the most popular of all cryptocurrencies, because it's unbreakable, right? The amount of computational power that goes into mining, right? So confirming the consensus of the state of the ledger, the amount of computational power put into that also creates its security. And so because more effort is put into the state of Bitcoin's ledger, it also makes it the most secure. So it's immutable. As I mentioned, the cryptography earlier, it's cryptographically secure. The cryptographic proofs that Bitcoin uses have never been broken. And so, you know, it's all open source code, anyone can audit it. And so if there was ever any concern of anything not being secure, it would be pointed out immediately and fixed. It's borderless, right? Anybody that has a computer or a cell phone can interact with it. And I can transfer an Bitcoin, or if it was any other blockchain, I could transfer an asset to Roy just because I want to. I don't need someone's permission. I don't need a clearinghouse, a bank in the middle, any intermediary or middleman. And some things are, when we say near instantaneous, it's relative, of course. Some blockchains will transfer an asset between two parties in a second or less. Bitcoin takes approximately 10 minutes to transfer a transaction. And so, you know, it's not as instantaneous as the ones that can do it in a number of seconds. But if we're talking about, you know, two of us on this call sending $20 million between each other, you know, that never happens in 10 minutes, right? It's impossible. You always have a bank in the middle that holds it up and wants to do more KYC AML, and things get delayed. And so because this is all software, it's also programmable. And so that makes it automated, and it means that we can interact with it, and not just humans interacting with it, but software, programs, computers interact with it, that perform by the rules that we people predetermine. So we can actually have computers doing transactions and doing business, and we don't have to intervene. So how would I send Bitcoin to Roy? The way we do this is by using what we call a wallet, and it's a lot like using email. So when you use cryptocurrency, it's important to know that most cryptocurrencies, once you hit send, there's no undo button. So just like with email, when you hit send, there's not an undo. As soon as you broadcast that transaction to the network, a miner looks at it, a computer on the network that confirms transactions. When they see that transaction and they see there's a nice little fee attached to it that will incentivize them to include it in the next block of transactions, they look at it and they say, oh, just as an email has a to address, a from address, a header, subjects, and content, they look at a Bitcoin transaction the same way. And they say, oh, look, there's a from, there's a to, there's an amount, all the necessary things are there, it's valid, so we'll go ahead and include it. So there's no undoing. And there are some rare cases where these things can be possible, but for the sake of this conversation, we'll say it's, once you hit send, that's it. And so just like with email, you have an email address that you receive emails at. And so if I want to receive an email, I just give you my email address, and you can send all the emails you want to me. But in order to access those emails and to be able to send emails, you would need the password to my email account. And so analogously, cryptocurrency acts in the same way. You have a receiving address called a public key, and you share that with whoever you want to send you any cryptocurrency. But just like with email, you need the password to send email from your account. With cryptocurrency, you need a private key in order to send cryptocurrency or Bitcoin. And it's this private key that you have to protect, just in the same way that you protect your email password. So that way, people can't get into your email account. Any questions about this? All right, we'll keep going. So I think a lot of people wonder why people want to use cryptocurrency. When the internet was being built, at first we were looking for ways to just communicate. And so things like email were created. There were things created to be able to share files. But then it became a little more interactive. And people realized that if we could interact more with this interface, then it can be more meaningful. The experience can be better, can be more enlightening, more educational. And so people started creating all these websites, these software platforms, where the platform itself, which we call here the application layer, that's where all the value existed. But the way that the email is sent, the way that the website's delivered, the way that the files are delivered, ran on top of protocols. So when you send an email, I don't know if you've ever had to connect your Outlook to an email account, a pre-existing email account, you have to type in the incoming server, outgoing server. It uses this thing called SMTP protocol, and you got to plug in some URL, some server address there. So email runs on this SMTP protocol underneath, but that protocol isn't what's valuable. Gmail is what's valuable. Hotmail is what's valuable. Microsoft is what's valuable. This application layer above the protocol. Websites, every time you go to a website in your browser, you see HTTP. So every website is delivered over the HTTP or HTTPS protocol, but that protocol has no value. The websites themselves have value. So Facebook, Twitter, they have value. And what a blockchain does is it completely changes that model. It's also worth pointing out that back when the internet was first created, there were certain features that were created, and some of them we see all the time. When we go to a website and the page doesn't load properly, I'm sure we've all seen that 404 error, right? That 404 error that you see it's a code. It's a 404 error. It's a 404 error code, and it references something specific that just happened that failed. And there's a whole list of these codes that were created for when certain events happen on the internet. There's a whole series of codes that were created back in the, 80s, 90s for payments. They've never been used. There was originally an idea that we would be sending money over the internet, but we've never actually used those things. And so the idea of being able to send money instantaneously over an internet protocol has always kind of been a vision by those that thought of what the internet could possibly be. But it wasn't really until Bitcoin that became possible. And so you have the creation of this protocol. Bitcoin is a protocol. And it's where the value is created. And then applications are built on top of it, but these applications, they're all open source. A lot of them are, meaning they're free. You can audit the code, but you want to be able to audit the code of these pieces of software because they are moving your money back and forth. And so you need to be able to verify that the software you're interacting with isn't going to take your money. And so this protocol layer is where the value resides in the world of blockchains. And the application layers on top often aren't really where the value resides. So this protocol layer with Bitcoin, it's quite simple. There is a language, but there aren't many commands that you can do with it. It's very, very basic. The way most people interact with it is, I have some Bitcoin, I'm going to send some Bitcoin. So I put the to address and I hit send. And Bitcoin, the Bitcoin nodes on the network, they kind of do their thing to make sure that that amount of Bitcoin gets sent from one person to another. You can do a little bit more complex things. Like if I wanted, I could make one transaction and send that Bitcoin to 20 people. And so that's a fairly complex transaction. I can actually make a transaction where I don't actually send any Bitcoin, but I can just write a message into the blockchain. So there's not a lot you can do with Bitcoin, but there's other blockchains that have things that are called smart contracts. And these smart contracts make the interaction with the blockchain very much like the interaction with a piece of software on your computer. And so these smart contracts, what I write here, are code written on a blockchain that automatically executes upon the satisfaction of a predetermined event or condition. So it's creating a program, but it's a program that tells money what to do based on some given set of conditions and parameters. And whenever you interact with it, those conditions that are predetermined get put into motion. And you can have one smart contract that interacts with another and another and another. And so you can create this whole chain of events that do something fairly complex. And so the value in this is that you can create a financial ecosystem that has quite a bit of complexity without any company, person, people doing anything. It just runs. And it doesn't even need a computer. You don't have to have a server at a data center that's actually doing anything, because all of this code, all this business logic is all embedded into the blockchain. You interact with it, and in the way that miners on Bitcoin just look at valid transactions, include them into the ledger, and process the transaction. With blockchains like Ethereum that have smart contracts, the miners are processing the business logic for you and moving the assets according to what the business logic and the smart contract states it should do. So when you can start creating these smart contracts, these scripts, these programs that interact with assets, whether these assets have value or not, they may or may not. If they do, then you can do things like remittance and peer-to-peer lending and microfinance. You can process e-commerce transactions without having to use a payment processor and a bank. But they may just be data, right? It could be healthcare records. There's not any real value in this. You're just storing it and interacting with it in a way that you're not having to rely on, some large corporation that tells you how much you're going to pay next year, more than this year. Title records. Back in 2015, I started a company called Title Hash, and I was thinking about how land and mineral title could stand on its own and not have to be controlled by the title insurance companies. Same thing with voting, right? Today, there's a handful of companies that control, all the voting, whether that be corporate proxy voting for public companies or elections for politicians. You can create a system where if your voters have the knowledge, the capability, the technology to interact with that system, then they can vote. And so this is actually being implemented and piloted now for the corporate, the public company proxy voting systems. And then under smart contracts, we have digital rights, wagers, escrow. It's very easy for two parties to interact with a smart contract, where the smart contract puts something into escrow, and the receiving party says that they received the thing that they paid for, and then the funds get unlocked and sent to the seller. And then in securities, so I worked on digital securities for. I started interacting with them in early 2017, and I actively worked on digital securities until late 2021. I worked with many companies that wanted to issue digital securities. I helped them raise money. I helped them structure their private placements, their PPMs. And this can be done with equity, can be done with debt, and private markets. I mean, there's a number of alternative trading systems here in the US where private securities have liquidity and can be traded. They technically could be high frequency traded if you wanted. There's an issue around liquidity for these things because you need market makers. And so you need to build out this whole complex ecosystem for it really to thrive, but it's a work in progress and it is making progress. This is something that I can speak about extensively, and we can kind of go down this path if you guys have any interest in that. And don't hesitate to post questions, because when I'm done, then I'm going to look back at the chat in order to dive into more detail. So we talked about some benefits about Bitcoin, and I think it was important to kind of touch on those, but getting into why companies really should be looking at this. It can be hard to wrap your head around some of this stuff, because there's a big learning curve to implementing this technology. But for the right company, it could make sense. And the reality is that for most companies, it makes no sense at all. So if you're a company that wants to do business internationally, and your customer base, let's say you're in gaming. People in gaming are pretty technologically adept and can figure things out that are fairly complex. And so let's say you're a gaming company. The ability to have the global reach, being able to accept payments from any country is useful, with no chargebacks, no reversals or fraud. Not having to interact with credit card companies, right? That's big. If I've built a video game where people all over the world connect to play it, it can be very useful for me to give them the ability to make payments to me with very, very little friction, and without having to give 3% to some credit card processor. So the cryptocurrency itself, it can't be counterfeited, can't be diluted. There's no risk of identity theft, because what you hold is what you hold. You cannot forge that. You can't tell a lie, right? So why else would a company interact with this? Interesting takeaway from a company called Bitwise. They have this research paper that they produced a couple years ago, and at that time, the statement was true, and I think it's still true today. So Bitcoin would have contributed positively to a diversified portfolio's cumulative and risk-adjusted returns in 74% of one-year periods, 97% of two-year periods, and 100% of three-year periods since 2014. That's assuming a quarterly rebalancing. It's a really interesting takeaway that I think a lot of people don't realize, that if you take any given period of time from 2014 to today, over 3 years, you're making money, and you're probably making quite a bit. And so that's why some companies are starting to hold Bitcoin on their balance sheet. The biggest one being MicroStrategy. But Tesla holds Bitcoin on their balance sheet, as do dozens of others. And the decision to do this has to be done with a very long-term strategy, meaning you have to be capitalized enough to take on the risk because it is a volatile asset. What I was mentioning earlier about smart contracts and encoding financial transactions into business logic without intermediaries, it's important to know what Wyoming is up to. The politicians in Wyoming are very bullish on this technology. They like to really push the envelope and give entrepreneurs an ecosystem to innovate. I'm a firm believer that if you regulate away the freedom for entrepreneurs to be creative, then they'll go other places. And so Wyoming is really leading the US in giving these entrepreneurs the ability to innovate. So SEC Commissioner Hester Peirce back in 2020 or 2021, I forget which, she proposed the token safe harbor proposal, and she rolled out a second version of it. And it was ultimately this safe harbor that gave companies the ability to create what's called a decentralized autonomous organization. This is a company that's not a company. It has no shareholders, and it doesn't need them. And the reason why this organization doesn't need shareholders, going back to where the value resides, not in the application, but in the protocol. If you create a cryptocurrency, and the cryptocurrency is the thing that has the value at the protocol level, then the shares in the company that builds the application, it doesn't matter who holds it. It doesn't matter who holds shares, because the asset on the blockchain is the thing of value. And so a decentralized autonomous organization is an organization that is governed by those that hold a cryptocurrency or a token. Not actually, it's a token that says, maybe I have one governance vote per token I hold. And if there's 100 tokens and each person has one, then 100 people have one vote. Or there could be 5 million of them, and one person could have 300,000, another person has 50,000, and then then there's some long tail distribution of that. And again, you still have tens of thousands of people participating in the governance of an organization that has built out an entire financial ecosystem on a blockchain, but there's not a UBO, right? There's no board. There's no people that the organization answers to. It only answers to those people that vote with their governance tokens in this decentralized autonomous organization. It all exists on a blockchain, and it's all coded into those smart contracts. And so our SEC commissioner actually helped make these things possible. Wyoming is really the only state where if you wanted a bank charter to custody cryptocurrency, it's the best state to go. They ended up granting, I think, 5 what they call speedy licenses. And these are Wyoming bank charters where custodying cryptocurrency is why this speedy charter, their speedy license was created. And so one of the really large cryptocurrency exchanges here in the US called Kraken, they have one of these charters. And then there's 4 others that are there, and they haven't issued out anymore. I think they're waiting to kind of see how these 5 banks progress, and it's a long process. And obviously holding as an investment, right? I mentioned Tesla and MicroStrategy, they're holding Bitcoin as an investment. And the reason they do this is because there could be really large gains. If you guys have been paying attention to the crypto ecosystem, the market cap of crypto recently, we've seen numbers come way down off of all-time highs here over the last month to large drawdowns, right? That's obviously, right, the volatility swings both ways. So there's risk that comes with it too, and you have to be able to kind of weather the storm and do so intelligently. The reason we're seeing these companies fail recently is because they over leverage themselves. They get a little too optimistic, I think, and they don't prepare themselves for when things go bad, because eventually they will. Big issue that I think a lot of CFOs are trying to tackle these days is the mark-to-market issue, because GAAP treats cryptocurrencies as intangible assets, so they're subject to impairment. So I think those that are struggling with this the most there's a lot of Bitcoin miners, especially the public companies that struggle with this. The public companies are having to report their Bitcoin in a way that mark-to-markets the Bitcoin at the lowest price in a quarter, when in fact they mined it every day, and every day it was a different value. But over the course of a quarter, if the price of Bitcoin was the lowest on the very last day, they have to say, no, we got all this Bitcoin at that lowest price. So it's not good for these companies because it makes their valuations look bad. And so there's a number of companies that are trying to do something about this, and they're working with the who is it? The you guys could probably tell me better than I can. The FASB or something like that, in order to change these accounting standards so that companies dealing with cryptocurrency don't have to be subject to this requirement of the way that the intangible assets are currently required to be reported. So other risks: care, custody, and control. So if you decide that you're going to start holding a cryptocurrency for some reason, or if the company that you work at or own, by its very nature, is what we call a crypto native company. So a crypto native company would be like a Bitcoin miner, or a company that really doesn't need to hold much cash, right? Because all of its business is done with cryptocurrency. It's its main source of revenue. It's what they hold in their treasury. These are crypto native companies. And so if you're working at a company that is holding crypto or is going to, more so in the past than today, custody was a huge concern. These things are being solved with better and better solutions every year. But the social engineering and misinformation risks are real. There are adversaries out there that if they know that you hold a lot of cryptocurrency, they will try to take it from you. And the reason for that is because, like I mentioned earlier, cryptocurrency being like an email, it's non-recourse. So if someone actually can take your Bitcoin, you're not getting it back. There are insurance policies. Lloyd's of London, Aon, Munich Re, all these companies are insuring different types of businesses in the crypto ecosystem. So there are insurance policies. The premiums vary a lot depending on what you want covered. But the software solutions for things like custody are getting much better. And you've got great software out there that implements a set of rules that kind of put, I guess you could say, stopgaps in place, or rules so that depending on what moves from where, how much, then it may require a manager to approve the transaction, or if it's a higher amount, then it needs an executive to approve it, or the CFO or the CEO to approve if the value of that transaction exceeds X or Y or Z. So there's good solutions for managing the cryptocurrency, and also these solutions that exist today. They'll require your phone to hit the approve button. But if you lose your phone, that's okay. They have a solution for that. So this was always a big concern in the early days of crypto, when you might have had some Bitcoin on your phone in a wallet. You lose your phone, your Bitcoin's gone, right? If you didn't have it all backed up properly. But the way that these companies have built their software platforms for custody, they make it so that if that happens, it's okay. They can actually restore access. And then you also have custodians, and this is all they do. They just offer custodial services, and they can accommodate many different cryptocurrencies. They can accommodate digital securities. And we can get into the whole custody thing if that's something you guys want to talk about as well. So regulation. I think it's interesting that SEC Chairman Jay Clayton back in 2018 said that this distributed ledger technology, meaning blockchains, may in fact be the next great disruptive and productivity enhancing economic development. And I think when he said this, he wasn't just referring to things like Bitcoin. He's also talking about federated blockchains and private blockchains, because all these are kind of included in the term distributed ledger technology. You may hear some people refer to it as DLT. But I think he's right. I think that given enough time, we will see public equities and bonds and T-bills and all these assets that exist today existing on blockchains, because it is more efficient. It's more auditable. When catastrophic events happen, when black swan events happen, when a company kind of hits I don't know, say they're going into bankruptcy. Being on a block, having all your transactions on a blockchain can actually make it very easy to conduct an audit. So the CFTC, this may be a bit dated, but they determined that virtual currencies are properly defined as commodities, subject to oversight under its authority under the Commodity Exchange Act. Their jurisdiction is implicated when a virtual currency is used in a derivatives contract. So I think that is still true. Or if there's fraud or manipulation involving a cryptocurrency traded in interstate commerce. SEC guidance focuses on cryptocurrencies, not blockchain technology. So the SEC has stated that Bitcoin and Ethereum are not securities. And then what I was mentioning earlier about how the state of Wyoming is the first state, the only state where you can actually go register a decentralized autonomous organization. The first DAO that existed, I think, was in 2015. It was called the DAO. And so the DAO was actually hacked. And when that happened, there's a report of the investigation where they reference Section 21A of the Exchange Act to advise those who would use a DAO or the distributed ledger blockchain enabled means for capital raising, that you have to take appropriate steps to ensure compliance with U.S. federal securities laws. So because of this hack that happened, this DAO that existed was actually, at the time, it broke a world record for the most money crowdfunded in history. Now today, that's been blown out of the water, but at the time it was a really, really big deal, because this largest crowdfunding event in history happened on the Ethereum blockchain when Ethereum was a year old, I mean, in its infancy. And so the SEC stepped up and really had a lot to say about it, because it was kind of a monumental moment in the evolution of blockchains and cryptocurrency. So CFTC has its things to say about crypto. So does the SEC. Obviously, the IRS does as well. So is it a currency, property, security, we talked about its mark-to-market issue for companies that are holding it on their balance sheet. So as a currency, it's like a sovereign. So they are like sovereign currencies because they're used to purchase goods and services. Treated as property for federal income tax purposes. So depending on how the cryptocurrency is held, it can be classified as business property, investment, or personal property. With securities, like I said, Bitcoin and Ether, on the Ether being the cryptocurrency of the Ethereum blockchain. With those exceptions, it's generally advised to seed cryptocurrencies and tokens. I think they should conservatively be considered securities. It's not to say they are, but the SEC has never come out and explicitly stated that any others are not securities. And then as intangible assets, the FASB agreed to add a project to review accounting for exchange traded digital assets and commodities. And it's probably going to take years for this change to happen. But the fact that it was agreed to be added on as a project on a 7-0 vote for it, I think is a really good sign that this will move in the right direction. It's just going to take some years for it to occur. Venture and market trends. If you guys want to talk about anything on this topic, I'm all ears. I just threw a few things out there that I think are relevant as of kind of this quarter. So the bear market that we're going through right now was the result of, I think, 3 major events. The first being that a blockchain called Terra and its stablecoin being a cryptocurrency or token that is or achieves to be pegged to a stable asset, most often considered the US dollar. This asset became depegged from the dollar, creating a massive sell-off of this stablecoin that was supposed to be worth $1. And so doing that, and when that happened, it created kind of a ripple effect in the markets that made all the cryptocurrencies, or almost all of them, fall. And then just a matter of a few weeks later, a company called Celsius, which essentially acted as a bank. They offered yield to people that would deposit their cryptocurrency with them. They were interacting with an asset that represented another asset, but that other asset was locked. And it's locked until some time in the future. We're not quite sure when it will unlock because it's dependent on developers testing technology. This asset that they created to hopefully make this locked asset liquid lost its liquidity. And when that happened, there was some insolvency, and there was over leveraging of this asset. And so this company had to freeze withdrawals, which then created more panic, and then the markets came down even more. And then just a couple of days after that, one of the largest hedge funds in the cryptocurrency space, I think at the time they were managing north of 16 billion, announced that that they were also over leveraged. And so it looks like they're, I don't know what the state of them is today, but last I checked, not good to see one of the largest hedge funds potentially collapsing. And so a combination of these things all happening back to back has created a lot of instability. And I think a lot of this is stems from improper risk mitigation and just irresponsible business models. And then, so this is kind of the talk of the town lately, right? Just because crypto is down. Entering legislative offices with bipartisan agendas. So while all these catastrophic events are happening with these hedge funds and these institutions that exist within the crypto ecosystem, you've got 2 senators, one on the Democratic and Republican side, came together to create a bill that really promotes the flexibility, innovation, transparency, and consumer protections in order to integrate digital assets into existing law and provide certainty to the growing industry. So this bill that was just introduced by Senator Loomis and Senator Hildebrand is really one of the most promising pieces of legislation that could make its way all the way to, hopefully to some degree or some derivation of it that hopefully looks somewhat like its original form may actually be passed. And so there's, I think, a lot of people doing some great things. There's a lot of political action committees. There's a lot of people that are trying to educate politicians so that decisions aren't made on ignorance. So we want politicians to really understand what this is, how it works, why it's useful, why it's important, and how it can help build a better future if used properly. There's the reason why major institutions, pension funds, endowments haven't quite moved into this asset class yet is because of the lack of regulatory clarity. And it's the reason why digital securities haven't quite taken off, because the SEC hasn't issued as much clarity as people, big investors want to see. Biden did issue an executive order, was that a month or two ago, really kind of pushing the legislators to give more clarity around cryptocurrencies and digital assets. So, hopefully all this results in the next few years with more clarity so that more companies and institutions and banks and investors will participate, and we get to see this kind of really become what I think we that have been in the space for a long time have kind of always hoped that it could become. I started watching banks pilot blockchain technology as early as Q1, Q2, 2015. And now 7 years later, they're interacting with it a lot more. I speak to these institutions quite often, and they're all kind of on the edge of their seats trying to turn on the ability to be able to custody Bitcoin for as many clients as they possibly can. So they want to do this, but there's only so fast they can move when there's a lack of clarity from the regulators. Retail adoption. In the early days of Bitcoin, a lot of people thought that this would be what we use to, go buy a cup of coffee. But it wasn't very efficient. And so we said, you know what, Bitcoin's a store of value, like gold. But technology evolves, and there's new innovations. On Bitcoin, there's something called the Lightning Network, which actually lets you send Bitcoin to somebody in under a second, and typically no fees. So instantaneous transactions that are free. And this is decentralized, right? You do have a kind of an escrow agent in the middle, but it's just a node on the network. It's a computer that's holding some Bitcoin that captures yours and sends to the other person. And so with more and more innovation, I think that we are actually seeing the ability for some of this technology to be used in retail adoption. And retail adoption is where, we're going to see at current adoption, I think somewhere around 2% of the world population owns cryptocurrency or is interacting with it to some degree. But things like the Lightning Network can take that 2% and take it to 20% or more. And then we have CBDCs, central bank digital currencies. So I don't know, about 4 years ago or so, it was really the first time that central banks started thinking about how they could utilize a blockchain in order to digitize their fiat currency or sovereign currency. China is really leading the world on this progress. And the UK and the US are kind of lagging behind. We're kind of waiting and waiting and waiting. And it's getting to the point, though, where hands are being forced to say something about what we're doing and what our plans are. And so Biden's executive order that came out this year, I think was more focused on central bank digital currencies than anything else. And so he's really pushing for progress to be made there and for us to officially state what our plans are as a country. So it's inevitable. It's going to happen. And given enough time, every country will have a digital currency. So the US dollar will be able to be minted, issued, distributed directly by the central bank. So I have a slide that I think takes an interesting perspective on this. I think the initial thought people have when they think about a digitized US dollar is that it's great because it would allow for me to go anywhere in the world, have as much money as I want on my phone, interact with e-commerce and just do things more efficiently. So this is the slide, and down the middle are the properties of money, right? Money is digital, what is in the case of Bitcoin and a CBDC. It's durable, acceptable, portable, divisible, and uniform, and that's great. The rest of this compares what a world of CBDCs versus a world of Bitcoin looks like. And the case of China, I think, is the perfect example of really overreaching and using a CBDC to control a population. How a CBDC is implemented and utilized is up to the central bank. And our Fed will eventually make some proposal, and I don't know to what degree it's going to be discussed or who's going to be able to have input. I guess the banks. I don't know who else beyond that, though. And so it will be unlimited supply, as the US dollar currently is. It will be completely centralized by the central bank. It'll be as opaque as they want it to be. So you may be able to see your transactions like you can with your bank account, but that may be it. They would, of course, be able to see everything, always, every little detail across the entire population, not just population, but everyone that touches a US dollar anywhere in the world. It'll be closed and permissionless, or permissioned, most likely. It could have varying degrees. And depending on the rules that are implemented, there could be risk of seizure. If they roll something out, if a central bank rolls out a CBDC that doesn't have any risk of seizure, it have to be coded into the blockchain, right? But if it's centralized, then those rules can be changed at any time. And so in any blockchain that's centralized or has any degree of centralization, then you will have no privacy at all. So the idea of cash will be gone, right? So if I give Roy $20 when I see him face to face, my central bank, my government doesn't know that. My bank doesn't know that. And if I don't want them to know that, they won't. In this case, they will all know that. And it also enables censorship. So this is a world of CBDCs, and you have the world of Bitcoin and other cryptocurrencies that are decentralized and are permissionless, right? I don't need anyone's permission to participate. I can if I want to, and it's my decision. And so you guys can run down the list here if you haven't already and read through that. But it's an interesting world where, the reason why Bitcoin was created was as a response to the 2008 global financial crisis. When Lehman failed, I think it took about 30, 40 days for the creator of Bitcoin, Satoshi Nakamoto, to write the white paper and publish his plans to create Bitcoin. And it was a direct response to the bank bailouts. All right, so that was an hour. I see a bunch of questions here, so I'm just going to run through this. Let me see. Roy, any thoughts, any feedback, any?
No, just keep rolling, Adam, on the comments in the chat box.
Sure. Okay, so would like to chat on your thoughts on securities going digital? Worked with developer Ambisafe, who did development for many ICOs. So that's Jack. Also saw some involvement in Macau. Is this for crypto ATMs or doing advising? Securities going digital. I think I mentioned earlier, it's inevitable. It's a matter of regulatory clarity. And so as soon as there's more regulatory clarity, then more and more companies will issue securities on a blockchain. I mentioned that shareholder proxy voting is already a work in progress. Sooner than later, shareholder proxy voting will be conducted on a blockchain, and most shareholders voting probably won't know they're using a blockchain. Most people that interact with digital securities on blockchains will not know that they're interacting with a blockchain. Transfer agents will. The DTC will, right? But I think most people won't really know. It'll be there as it's like a backstop, right? It's an auditability tool. And it also means that you could probably, the reliance on maybe like server infrastructure doesn't become, it looks different. Like it's still important. It's like you have to run nodes on this network that confirms these transactions, but it just looks different. So I'm familiar with Ambisafe. I think they're a pretty good company. I like them. I know a couple of people there. But yeah, there's a lot of companies that are working on making sure that digital securities are adopted. There's a lot of money that's been put into that. Know a number of companies in the ecosystem that have 10 plus years of runway. So they're not going anywhere. And the SEC keeps approving alternative trading systems to enable the secondary markets for these digital securities. And so as this ecosystem develops, and as there's more regulatory clarity, I think we're going to see more and more of it, but it's taking a while. You know, we've been working on it for the last 4 years, 5 years, and we've probably got another decade to go to where we get it to the point where some of us are actually interacting with securities on blockchains. And as I mentioned, you probably won't even know you are. So for smart contracts and alike, are miners needed to verify transactions? And if yes, how are the miners compensated? So yes, you have to have miners to verify transactions. Miners verify transactions dependent upon the blockchain in a couple of different ways. With Bitcoin and Ethereum today, it uses a consensus mechanism called proof of work, where miners have to actually expend energy, like electricity, in order to participate in a computational race in order to try to win that reward for helping verify those transactions. The other type of consensus is called proof of stake. So on other blockchains, if I have 1,000 coins, coin X, whatever that is, I can stake it. And so if I participate honestly, then and I successfully confirm a block of transactions, then I can win a block of reward coin X. If I act maliciously, and other miners see me acting maliciously as an adversary on the network, then I can actually be some of my staked coins, those 1,000, maybe I lose half of them, right? So you're incentivized to do the right thing. And so these, so the miners need to verify transactions. And the reason they do this is because typically, and I'm going to reference Bitcoin and Ethereum on this. It's hard coded into the blockchain, into the software that runs the chain. It's hard coded that these people that verify these transactions, and the miner that successfully does this is rewarded with new Bitcoin or new Ether. They also receive fees. So whenever I send someone Bitcoin, I have to include a fee. If I include zero fee, then a miner is not incentivized to include my transaction in their block. Right? It's a blockchain because it's a chain of blocks. It's not exactly accurate, but I think it's the simplest way to think about it. So a block is like a page in the ledger, and then a bunch of blocks chained together is like the whole ledger. And so the reason why a miner would include you into their block of transactions is because they get some small fee out of you. And so I don't think it has a lot to do with smart contracts. Other than that, it's worth noting that smart contracts, the fees to execute a smart contract increase as the complexity of the smart contract that you're interacting with increases. So if you are doing a simple escrow transaction, your fee might be quite small. If you're doing something very complex where you have to execute a lot of functions in the code, then your fee is going to be higher because you're going to require more computational power to process through all that business logic. And also the miners make more money because they've done more work. Back to Bitcoin. So miners receive Bitcoin as payment for verifying transactions. Who or how approves the miner's work? The approval of their work is, so a miner can only approve valid transactions, right? They have no incentive to include an invalid transaction. And if they wanted, they could. But all the other miners on the network would analyze the block with the invalid transaction that a miner approved. And they would all look at that block that just was approved by that miner, and they would go, no, that's not right. That's untrue. And this actually happens all the time. So with Bitcoin, you have a chain of valid blocks. And what will happen is that a block might be invalid. And so the miners will void that one and go off in a new direction. This actually happens every day. And it can happen for a number of different reasons. It could be that, yeah, let's just keep it simple. It could be that a miner accidentally had some parameter in their mining software not set correctly. Somehow a transaction got in that they shouldn't have let in, and they were wrong. All the other miners will say, that's incorrect. We're going off in this other direction, and everybody will join off in that new direction. So I think, so they all keep each other in check. And so as long as you have the majority of the people keeping the others in check, doing the right thing, then they're all approving each other, and they all collectively, because financially they're incentivized to do the right thing, they will all go in the direction, they'll take the chain in the direction of all that is true and valid. Let's see here. Next one is the OCC has also granted about 5 charters. Is there a benefit to OCC versus Wyoming charter? I am not sure. I think my only thought on that is just that in Wyoming, things happen faster, easier. And so I think that's why we tend to see that more people, more companies go to Wyoming to work within the cryptocurrency ecosystem. Companies report the value of their assets and liabilities of a specific date. If the value of a marketable security, such as a currency, declines or goes up during a quarter, how would you value cryptocurrencies if mark-to-market is not acceptable? I don't know, Dan, can you explain this a little bit more?
Well, your comments earlier in the discussion were the mark-to-market is not a great way to value a crypto, but at the end of a quarter, that cryptocurrency, for instance, has, Bitcoin has $20,000 of US dollar value as of a certain date. Why would I have that on the books at 60,000 when I bought it for 60? And there's no way for me to realistically say that it's going to be worth 60 next week when I need to sell it. It's worth 20 right now. And that's why I led it with that reporting of assets and liabilities as of a specific date, because that's where the valuation comes into play. You have to report what's, the value of your assets. And I'm going to assume you want to include cryptocurrency as an asset. It's something that you own.
Yeah, and that's why it's mostly a problem for the miners, because the miners don't buy it. They don't have a price that they paid for it. All right, so the way that the miners see it is like, why am I reporting the value of my assets at a given time that doesn't have any correlation to when I received it, which I put the work in to receive? Like, they're like, I did work to receive this asset, I didn't buy it. Right, so I think they see things a little bit differently, but I don't have a great answer for your question.
Okay, because the flip side of that argument is also that, if I make money in a different country in their currency, I did work to make that 100,000 whatever lira, and at the end of the quarter, that 100,000 lira is still sitting there as lira, but its value has gone down. I reported income based upon that. And I still am going to take a loss on that because I can't convert that. So anyway,
But do you report that as an intangible asset? Or as
that's more of a currency?
No, you report that as currency revaluation.
Right.
Yeah.
You take, and for public reporting, I think that goes, I'm not public, so I forget the term, the OCC, other on your foreign currency exchange rate variances.
Yeah, but irrespective of that, Adam, I think I'm supporting Dan on this one. What miners think or want or disagree with, there are very specific reporting requirements by US GAAP developed by AICPA, and so I think recently, I don't recall exactly. Recently, they adopted provisional guidance for reporting investments in all these cryptocurrencies as financial instruments, and so as such, they are subject to the rules of reporting financial instruments. And I absolutely agree that they should be revalued at to market at the end of the reporting period. Otherwise, it just doesn't make any sense, and it doesn't represent the true and fair view of the assets of the company to outside investors.
Yeah. Unfortunately, I can't go into a lot of detail on this point. It's one that I've kind of just scratched the surface on. Does the market truly believe that Tether is one-to-one today with the fully mark-to-market value of securities and cash?
Sorry, Adam, but you were talking about the other ones going down, and I still can't believe that Tether is considered one-to-one. So just throw it out there. Yeah, those corporate bonds are really worth what they are. Okay.
So just so everyone knows, in the world of stable coins, you have algorithmic stable coins that create arbitrage opportunities for traders in order to maintain a peg to the dollar. So this token is always typically within 1,000th or 100th or 1,000th of a percent off the dollar, or within to $1. And then you have asset-backed stablecoins, and the one that I think the SEC would, or that companies in the US tend to migrate toward because of its, there hasn't been anything bad to say about it to date, is USDC, which was created by a company called Circle, and it's backed dollar for dollar. For every USDC that exists, there is $1 in the bank, and they produce audits all the time, and it's always been true. And there's another one called Tether, which is backed by a basket, as Jack mentioned, a basket of securities and cash. And so, yeah, it's much more debatable if the assets backing it are actually, dollar for dollar. And they do produce audits, but the reality is that nothing has happened to date that has said otherwise. Enough people believe it to be true that it remains true, and it's used as the trading pair at every major exchange across the world, and so it has been true in people's minds so far, and according to the audits. So I don't know. I know that there's a lot of people that have opinions that think that it shouldn't be, that it's not true, and there's just as many people that are.
Okay, I guess I've never seen a true audit of it. So
they
analyses, yes. Audits, no.
Okay, I see what you're saying. I think the audits do exist.
Yeah.
I would have to dig it up, but yeah. Let's see here. Let's see, and then banks and regulations, which is why the banks and regulations, which is why Jamie wants to issue his own internal token, all settlement at bank versus giving a share of revenue to other bank services. Absolutely, yeah. I mean, so you're referencing JPM coin, right?
Yep.
And yes, you're exactly right. But we don't know, right? We don't know. And Jamie Dimon's doing this because if he does nothing, he'll get nothing. And if he does something, well, then maybe he gets something, right? The reality is that whatever our central bank, issues and dictates is really the way it's going to be. And what the regulators say will work will be what actually has to work. And yeah, I think it's, it's an opportunistic play.
Well, if you look at any USDC or any one of these, it's a settlement platform. So you want to talk Zelle, you want to call PayPal, you want to talk any one of them, they're all a settlement platform. And as long as you stay within their ecosystem, just like if you're an Apple phone, you're in their ecosystem, you have to pay the piper. So JP Morgan trying to take the initiative that, hey, if everything settles through me, I keep the whole dollar. It's the same scenario. It's a settlement platform. I don't care if you call it Bitcoin being transferred through there, Ether being transferred through there, anything being transferred through there. If it stays on their own ecosystem, they keep the revenues. And that's the important thing. And I think that's one of the things you did bring up in your presentation or discussion of the closed-end ecosystems. If you run them as closed-end, the money remains within them.
Right.
Transaction fees.
Right, and USDC is the perfect example, right? It's created by a company called Circle, and that's why they did it. So it's mimicking that, and for the same reason, yeah. So yes, you're completely right. Stephanie asked, can you say more about who are the miners today? Individuals, companies, governments, who are they likely to be in the future? Does reliance on miners present a risk to blockchains, digital currencies? And what if no one wants to mine? If other professions are more lucrative, right? So are they individuals, companies, or governments? They're companies. The type of company has evolved a lot over the years. It used to be individuals, and then those individuals created small businesses that started mining. And today, if you're going to mine a proof of work algorithm like Bitcoin and Ethereum, at least until the Ethereum merge, which then it will convert to proof of stake. But if you're going to mine Bitcoin, anything less than a $5 million initial investment into mining is considered really kind of too small to be a participant in the space. Companies that issue debt for Bitcoin miners really won't start any below 5 million, and some won't even start unless you're seeking more than 10 to 20 million dollars in debt. So they're companies that are really just dedicated to mining. There's some private equity groups that have created subsidiaries that focus on Bitcoin mining. Well, with the exception of Fort Worth, Texas, that's running like one Bitcoin miner. I don't think any governments are mining. And I'm just talking about the US. In other countries, I don't really know what the situation is in detail, but I've been at 2 Bitcoin mining conferences in the past month and a half. So I interface with Bitcoin miners a lot because at 2 Prime, we help companies that are sitting on net long positions of Bitcoin get yield on that Bitcoin by trading Bitcoin volatility options. And so Bitcoin miners sit on a lot of Bitcoin, and we help them get yield on that. So I interface with Bitcoin miners quite a bit. Who are they likely to be in the future? So the Bitcoin mining industry in the US has evolved a lot in the last year and a half. When China banned Bitcoin mining, it created an exodus to a few countries, the biggest one being, I think, the US. And most of the Bitcoin mining today, I mean, it was already happening quite a bit in Washington and Oregon, a little bit in Wyoming, and a little bit in New York. But now West Texas has become the Bitcoin mining capital of the Americas. And so who's in West Texas? It's all the oil and gas guys. It's the energy companies. And so who will they be in the future? I think that the oil and gas companies will be the miners of the future. I think companies that are focused on energy production, power production, they'll be the miners. The miners are wherever the most affordable power is located. It's why Bitcoin mining took off in China, because the miners in China had direct access to the production of the hardware, and there were plentiful hydro dams for them to plug their equipment into. So there were no gaps in the supply chain for them. Everything was right there, right? All the computer hardware, the specialized computer hardware that's required to mine Bitcoin was made there. And there's a lot of hydro dams throughout China. And so it was really opportunistic, because when a hydro dam has to let water flow through the dam, but it doesn't need to produce 100% of the power that it could produce, then that means that there's a turbine not running. And a Bitcoin miner goes to that dam and says, hey, you turn on that water, can you turn on that turbine, and I'll pay you for that. The hydro dam operator says, yeah, okay, I wasn't going to get anything for pushing that water through anyway, so I'll turn it on. You give me, I don't know, let's say hypothetically half of whatever I'm selling that electricity for. It's better than nothing. And so the Bitcoin miner got really cheap electricity. And the same thing happens here. So where we have stranded nat gas, right? We have natural gas that's stranded on oil and gas operation, oil is being produced. It's advantageous for a miner to go there and say, hey, you're flaring that gas. I'll take it. I'll turn it into Bitcoin. I'll give you money for that gas that you're just burning, which is a liability. And, I'll go wherever the cheap energy is. That's why I think nuclear makes sense. I think geothermal makes a lot of sense. Bitcoin miners will always just go to wherever there's potential for power production that's stranded. Does reliance on miners present a risk to blockchains and digital currencies? It's proof of work blockchains don't work without miners, but there is not really and so the blockchains have to rely on the miners because they don't exist without them. But a blockchain will run with one miner. So will Bitcoin ever have less than one miner mining Bitcoin? No. So I don't think there's any risk, right? It's all relative. We can get into attack vectors and how hash rate on the blockchain and difficulty fluctuates, but yeah, I don't think so. What if no one wants to mine if other professions are more lucrative? Bitcoin miners are mining Bitcoin below the current price, well below the current price. And some of them are capitalized enough to be able to mine, let's say, long enough to endure a bear market. I don't think anybody at this point is looking at Bitcoin and thinking, it's going to go to zero. So, yeah, I don't think the thought of if no one wants to mine, I'm just referring to Bitcoin, of course. I don't think that's in the mind of any Bitcoin miners. There may be other blockchains where mining requires electricity, and if those blockchains don't remain relevant, then yeah, the miners will go somewhere else. And a lot of miners that mine with GPUs, they jump between blockchains. They just jump to whatever blockchain is most profitable for them that hour or that day. But Bitcoin miners require a very specific type of computer that's created just for mining Bitcoin. And so when you commit to mining Bitcoin, you're not jumping around to just the next thing.